Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. I'm Ruchira and with me is our CEO Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Today we're taking up a question that's on every new investor's mind right now. Markets, they're at record highs. So should I start my SIP now or wait for a correction?
It's the most common worry, Ruchira, and everybody will be worried about either the market is too low and they're too scared to invest, or it is too high and they think that this may not be the right time to start. But that's the wrong thing to worry about. You need to find a way around it because market is going to be in this state all the time.
But psychologically, isn't it really hard to start investing when everyone around is saying market is overheated right now and we've all seen corrections follow?
It's the design of the market. Markets will always go up and go down, and over a longer period of time they go up, and that is the general premise. And more so now for Indian investors, that if you are confident that in 10 years time, 5 years time, 15 years time, 20 years time, we are going to be a better economy, we are going to be a bigger economy, we are going to be an efficient economy, we are going to be a larger economy, then these short-term worries will only hold you back. You will never get started. I think the trick is to really get yourself out of this loop, start somehow. And mutual fund SIP turns out to be the finest way because it's not a trick. It is not that you do SIP and it's a guaranteed return. Right now we are coming across a set of investors who are scared to start now. There are a large number of investors who started 1 year ago and they're not very happy. They say that I got only 6% return, 5% return, this, that. That's not the point at all. The point is that you have started investing. You have not lost money. Any market or any market exposure requires one surge, and that will happen at its own time. And the way to look at it is, you have started your recurring deposit in a market-linked investment, and this will generate superior return. If you haven't lost money and if you have been able to accumulate some money which you did not have in the first place, it's greatly confidence inspiring, and one market surge and it will all be over. You will have a far different belief, and you will not have these objections and questions and all kind of apprehensions crossing your mind.
So for this set of investors that you say they want to invest but are scared to do so, what should they do before they start investing?
You need to do some essential stuff. One is that must have emergency money. Have 1 month, 2 months, 3 months, whatever, you do your estimation, and that much money you keep in a liquid fund or keep it in your bank account. That's it. So that your day-to-day needs are not going to be dependent on that investment. Make sure that it is your long-term money. So if you have created that emergency fund, if you have created the safety net of health insurance, you are okay. And once this is done, then you can think long-term. Make sure that the money that you're investing is not needed for a couple of years, if not for many, many years. And get started anyway. Don't look for an excuse that I don't know the good fund, I don't know which fund, I don't whether index or not index. Or you will have 20 questions crossing your mind. Get started with a balanced fund. Get started with a small cap fund. It doesn't matter. Make sure that it is a long-term money and make sure that you're not making lump sum investment. And that is it. Things will be sorted.
You just said that somebody, if he has a lump sum, they should not invest all at once. How exactly should one go about it?
One is that any new investor and even experienced investor, they do their biggest mistake when you invest a large sum of money at a point of time which can well be followed by a market decline. And that could be devastating. That can completely drive you out of the market. That can create all kind of apprehension. That can create all kind of concerns which may not be true. And the way to deal with it is never make a lump sum investment. Now, how critical is that lump sum in your own overall scheme of things? If I'm earning, say, 50,000 rupees, and I'm with great difficulty, I'm able to save 20,000 rupees a month. Then if I get a lakh of rupees of lump sum accumulation, which I have to invest, I'll spread over at least 2-3 months. So that that 1 lakh rupee becoming 90,000 even intermittently, even for a brief period, will not be a very devastating thing. But I will actually think very negatively if I see a 10% decline. And Likewise, so depends on the scale of money. If you have sold your land and you got 2 crore rupee and your lifetime saving is going to be, 3, 4, 5 crore or whatever, then you must spread it over next 2, 3 years. Because then you run the risk of investing all that, losing 10, 15% in the interim, and that can scale you out of the market. So the whole idea is to gain exposure the way you start getting into a pond, exactly like that. Acclimatize yourself, make sure that you're not jumping at the highest depth with the greatest speed, which in this case, your scale of money is the force.
Right. Now, what would be the right mix for a beginner's portfolio?
Right mix for a beginner's portfolio depends. The beginners, if he's 40-year-old, never experienced anything, has only been doing, or not been able to save at all in the first place. And after that, ever since saving, then it is lying in the bank or recurring deposit or fixed deposit at most. He should start with an aggressive hybrid fund with a 5-year time frame in mind, making sure that life insurance, health insurance, everything is in place, because those things will give you the shock absorbers. That is something which is essential. It is a necessity that you have to really prepare yourself that you will not be scared out of the market. And if you don't have it, any kind of speech, any kind of talk will not persuade you, because you will start relating that it has taken so much effort to earn that money. How it can be, and your situation will drive you. We are all I would say a slave of our context, and those contexts you should fix yourself. Then only you can behave properly. And any kind of positive or motivational talk or me telling you that the market will make a comeback will not please you. Your situation should be such that you are prepared for it. That's one. Second is that for a 40-year-old person, aggressive hybrid. For a youngster, 22-year-old, maybe he can start with even a small cap fund. If you're unable to decide, maybe an index fund, maybe a flexi cap fund. Anything works. The initial 2-3 years, the idea should be that somehow you should get on board something and be there. Stick to it, understand it, and make sure that you're on track.
Right. You just mentioned that there's a set of investors who've been investing for, say, a couple of years and they're disappointed with their SIPs. So are they doing something wrong?
They are not doing anything wrong. All they need to do is console themselves. It'll be over and you'll be well off. And I don't think any investor will be deep in red today, even if somebody is doing a 1 year or 1.5 year SIP. Their faith will be rewarded. The point is that you can actually derive consolation from this point that if you are investing for many, many years, and if you have continued investing through this patch where there has been no return, it is great. You are buying it cheap. You are buying it at a level where, because assuming that this market, if it went up by 20%, all your incremental investments over the last 1 year would have been at 2%, 3%, 0.5% up and down. You are buying low. That is a consolation. At the same time, with the belief that yes, over a period of time, it will be, it will be a rewarding experience, and understandably so. And that's the hope. The critical thing for many investors who might be disappointed, and it will translate into a real disappointment for a long period of time, is if they have not followed the basic rule. They are not diversified. They have taken a bet on something. They have bought a couple of stocks, and it's not, something has gone down, or lack of understanding. Because many a times we think that we are investing thoughtfully, but we are basically speculating and we are just chasing the recent past. Right. Those investors might be in for some disappointment. It's time to course correct and make sure that you understand, diversify, keep it simple, and carry on.
Okay. And in short, even at all-time highs, one should start investing right away.
Oh yes, think of it. If you are starting at age 25 and if you're going to invest for next 35 years, 1 month SIP is going to be what part of your total investments? Barely anything. And so this is just getting started. And don't find an excuse that the market is high. Get started now. I think you'll thank yourself for starting early and being disciplined.
So that's your answer. Markets may be at high, but your discipline should be higher. Thank you, Dhirendra.
Thank you.
Thank you for watching and your appreciation. We look forward to your comments as always.